Okay, so in this video, I'm going to blow your mind. I'm going to show you a company that does cybersecurity, is a complete leader of its industry, does everything well, has great financials, great products, and great technological advancements. I mean, the research is great, the financials are great, everything is phenomenal, but somehow the price is 30% undervalued. I don't get it. Now, here's the thing. Lately, I've been getting more and more into these cybersecurity companies, and I've noticed a lot of these companies are actually undervalued. Now, I found a couple that I really like. Today, I'm going to talk about Fortinet, FTNT. I have my notes right here. Right now, the price is $148.39. I did my math, I did my DD, and I see this as a $200 company. Now, there's no fluff in this video, so I'm just going to show you why. Now, before we get started, let me explain what this company is. Now, Fortinet is a cybersecurity company. Where they actually shine in cybersecurity is they use actual AI to prevent hacks and breaches by improving your system from within and actually anticipating issues. It's really exciting. I'm not a cybersecurity expert. Don't hang me in the comment section, but I really like their preventative approach. But that's not the only thing they do. They do a whole bunch of shit in cybersecurity. These guys are pretty much the Scottie Pippen of the cybersecurity industry. They do every single thing well. They can shoot three-pointers, they can rebound, they can play defense, they can guard anybody on the floor, quite literally. I mean, this company is phenomenal, and they have great financials. The DCF looks brilliant, the management is good, everybody loves this company, and somehow it still has 30 halves. Somehow, I don't know what's going on with me today. Somehow, it still has 30% to give. Now, pay attention here for a second. These are the profitability grades. As you can see, they get an A. Why? Well, because they get almost 80% gross and over 20% Ebitda. That is phenomenal. That's really good. If you compare it to the industry right here, you see that the sector median is 13%. And here, the sector median is 47%. So these guys are leaders not only in the software, in the actual products, which they are, but also in the financials. They're growing great. But you get what I'm saying. They're doing really, really well. And now let's take a look at the growth grade. And right here as well, a lot of really good stuff. Remember, this is a $25 billion company. This isn't a startup. Look at their growth. Ebitda growth year over year, 35%. I mean, this is a company that actually has a lot of depth, but also a 35% year over year Ebitda growth. Revenue growth year over year, almost 20%. That is really nice for a company in this stage. Now, I want you to see some other interesting stuff here. And right here, I want you to pay attention to this. The short interest here is only 2%, meaning not a lot of people are betting on this company to actually fail. Also, as you can see, the growth rates are actually quite impressive. And this is what the company did in the past year, almost 30%. This still isn't indicative of how good this company is, because let me just show you the DCF and let me just blow your mind for a second. And before we take a look at the DCF, let me first explain to you what are you looking at here, because a lot of you have been asking me, well, Tom, what the hell is a DCF? Now, of course, let me just explain. What you're looking at here is a very extremely simplified version of what an actual DCF looks like. This is super simple, just so this video actually makes sense in a 10-minute format. Usually this thing would take about 5 to 6 hours to make. Now let me explain what are you looking at here. Let's say that you're trying to sell your farm and you're trying to figure out, okay, how much should I ask for my farm? I have no idea, right? And then you come up with two methods, which are both in this DCF actually. One method would be to actually calculate how much money the farm will generate over the course of its useful life, whether it's 10 years, 20 years, 30 years, right? Add it all up, discount it to today, because, we'll explain in a second, the money isn't worth today what it's worth in 30 years, right? Because a dollar today isn't the same dollar in 1975. Think about it this way, right? The other valuation would be to see how much farms in the area are selling for, at least comparable farms, and basically say, well, if this farm is similar to mine and they just sold for XYZ, my farm is probably worth about XYZ, right? There's two methods to do it. Both of them I'm going to use in this format. And how exactly does this work? Well, first of all, we're calculating the Ebitda. And Ebitda is essentially the earnings before income tax, depreciation, and amortization, meaning how much I generated minus gross profit, minus operation expenses, but not minus DNA, depreciation, amortization. That stays in. I'll explain in a second why. Then we're taking out the DNA. Now, why am I subtracting depreciation and amortization? The reason I'm subtracting it because this is not a cash flow item. It's not fair to tax me without taking into account how much value, for example, my phone lost, or my car lost, or my tractor, or every capital investment I have is depreciating over time. Well, excluding land, for example, but most of the stuff you own depreciate over time, right? As the years goes by, it becomes older and older and it's worth less, outside of collectibles probably, right? So depreciation and amortization are basically two ways to give me a tax benefit on the loss of value on my stuff, whether they're tangible or intangible. Depreciation is for tangibles, amortization is for non-tangibles. So I take it out and then I calculate my tax liability without the DNA. Then I add them back because it's still real money. Then I actually apply the tax. I reduce CapEx. CapEx is essentially how much I invested. I invest cash in developing my business. I build factories. I buy new tractors. That has to be reduced because it reduces the cash flow. Then, it's a very simplistic model. I get a free cash flow. Now, that free cash flow has to be discounted to today. Why? Well, because if I give you $1 million, you can go to the stock market, invest 1 million, probably make 5 million in 5 years, the way this market is going. So money today is worth less than money in the future because you can actually invest it and make money. So how do you reflect that? Well, the way you reflect that, and again, it's a very simplistic explanation. The way you reflect it is basically by using what is we call the WACC. WACC is essentially the weighted average cost of capital. Essentially, we look to reflect the risk and how much you can actually generate over the course of the next 5 years by looking at how much capital costs you. Now, of course, there's two types of capital. One is debt and one is equity. So you have to balance it out by the amount of equity you have versus the amount of debt you have. And then you calculate this formula that I'm not going to do here, but essentially you get a number that shows what your WACC is. Essentially, WACC is how much money you can generate from putting this $5 million back to today, bringing it back to today, how much money you can generate in 5 years, 4 years, 3 years, or whatever. Very, very simplistic explanation. It's supposed to reflect risk as well. That is why, even though we have a 0% interest rate now in the bank, I'm still going to use 10% for this company, because for SaaS companies, and this is what I call a classic SaaS company in cybersecurity, 10% is the way to go. It's kind of a standard thing. Now, once I brought back the money, that's not it, because look at this number here. We're all the way to 2026. Is this company going out of business in 2027? No, it will not. So what happens then? Then you see this part called perpetual growth valuation on the bottom on the left side. That is how much the company will grow every year to eternity. And that's why we use 4 to 5%, not more, because the company will definitely not grow indefinitely. But because we're doing a perpetual kind of hypothesis, of this perpetual growth, we're going to use only 5% just to reflect inflation and just a little bit more, not a lot. And then we're going to take this number, basically showing us the long-term perpetual growth, going to bring it back to today and then create what we call a present value of the terminal value. And to that, we're going to add how much cash we have versus how much debt we have in order to reflect the assets we currently have, or at least the difference in assets. And then we're going to divide it by the amount of shares we have and get an actual value at target price for the share. Now, while we do that, there's another way to do it, which is called the multiplier system, where you take the year 5, basically Ebitda, and you use the multiplier that is applicable for that industry to get a number which you kind of bring it back to today from 2026. And of course, in this multiplier method, you also have to add the cash and deduct the amount of debt you have in order to reflect the current assets. And again, the number gets divided by the amount of shares and you get a target price. Now, I actually do both. I average them out, and the average is my target price. Which brings us to the actual number you've been waiting to see. Now, this has been long, but as you can see here, this is the actual numbers. $162, this is for the perpetual approach. $233 is for the Ebitda approach, the multiplier approach, giving us $197 target price, which is a 33% from today's price. Now, I know this was long, but I really thought you need to understand how the methodology of this actually works. And by the way, I am not the only one who likes this company a lot. This guy is ranked number 12 out of 7,261 analysts on TipRanks. He's from Oppenheimer. We like Oppenheimer. He has an 80% success rate, 33% average return. And on Fortinet, he actually has a 28% upside, which is lower than me. He has them at $190. I have them at $200. But the dude has been right pretty much a lot. 37 out of 39 ratings were profitable for this company. He made 36% on this company. As you can see, it's moving on up. And based on what we just saw, I think it's going to move up even further. And as you can see here, this company actually complies with my favorite metric. Is the founder still there? As you can see here, Ken, the guy who founded the company in 2000, as you can see, he's the founder of Fortinet. He's still there. He's still the CEO. So he's still there at 58 years old. He's a billionaire and he's there to carry this company because he's passionate about it. I love founder billionaires who stay at billionaire companies because they love it. So as you can see, Fortinet actually checks off every single box with flying colors. Their management is phenomenal. They've been around for over 20 years. The founder is still the CEO. Some great analysts, top of the line analysts, think this company has 30% to give. I think they have more to give, about 33%. The DCF looks phenomenal. Their financials are insane. They're growing like crazy, even though they're a $25 billion company, only 2% short interest. These guys are generating over 20% Ebitda, over 78% gross margins. I mean, this company is insane. They're doing everything in cybersecurity, preventative, actual, everything. I mean, I'm not a cybersecurity expert, but I want to invest in the Scottie Pippen of the cybersecurity world. I think this is the company to go. I like it a lot. I'm going to invest and let's see what happens next. We'll see you guys in the next video.